Hi there, welcome to Kneppy Invests. I have recorded 600 millimeters of rain the last 2 days and it's still raining now. And in fact, there are some pretty bad storms just to my northeast. You might hear some thunder as I am speaking, but once these storms and heavy rain does shift to the south, or clear skies ahead over the next few days. Hopefully, because we really need to dry out. Anyway, we are heading towards the last day of reporting season, February reporting season. So we will see a lot of companies release the half year or full year results on February the 28th. So I do expect it to be a fairly hectic day in terms of price sensitive announcements released to the market. Now I've started to go through all the half yearly and yearly reports, and what I'm going to do is produce quite a few videos on companies that have released the half yearly or yearly reports. And I didn't want to do a dedicated video for each company because there are just so many companies releasing reports. But I've separated companies into 3 sections. Companies that released a good report, so I'll call them heroes. Companies that did not release a good report, call them zeros. And the companies that released sort of a mixed bag, and I'll call that a mixed. And what I'm going to do is pick out a company from each category, and that would be my video for you. So today I'm going to do a video on Kelly Partners, Chartered Accountants, and they are my hero company for today, and you'll definitely be able to see why they are a hero stock when you look at that chart. In fact, the share price rose 10% on the back of them releasing the half-year report. JB Hi-Fi, a mixed story there. Initially, I would have put them into my hero basket, but the share price has pulled back. And in fact, if the share price pulls back, say another $5 or $6, I will take a position in this company, and I'll tell you why when we look at the chart. And the zero of these 3 companies is ADOREBEAUTY. This is not the company you want to be holding in your portfolio at this point in time. In fact, if you bought into the IPO of ADOREBEAUTY, you are down big time because the share price has dropped maybe 70% since then. So let's get stuck into it. And the first company you'll be discussing is Kelly Partners. In fact, I'm getting a little bit ahead of myself. There's a couple of things I just want to touch upon before we head to Kelly Partners. The first thing is the market reaction to results. And a lot of people actually do get confused by this. They see a company they own in their portfolio, profits up 40%, revenue up 30%, and the share price drops, and they just don't understand how the share price can drop when revenue is up 30%, profits up 40%. But the market is not looking at the results in isolation. They have expectations in relation to the results. And if the company doesn't hit those expectations, the share price will drop a bit. So instead of looking at the actual results, you have to compare the results to actual expectations from the market. So that company that did have increase in profit of 40%, maybe the market was expecting profits to be 60% higher than the previous year. And this does confuse a lot of investors out there. The flip side is also true. Sometimes you'll see profit fall, revenue fall from the previous corresponding period, yet the share price rises. This is exactly what we saw with JB Hi-Fi. Treasury Wine was another one where everything fell, so you might think that was a bad result. But market was expecting worse, and that's why the share price increased for Treasury Wine and JB Hi-Fi. The other thing to take into account when you're looking at the market reaction to results is guidance. Has the company prepared or given any guidance for the rest of the financial year or for the next financial year if it is a full year result? And this is very important. The market wants to know how management are feeling about the business performance, and sometimes a company will give their first guidance for the financial year. So that's how the market reacts to results from a company, is how they compare to expectations and guidance the company might give for the rest of the financial year. When I look at all these 3 companies, there's a few things I am going to look at. The first thing is the 5-year financials on a half-yearly basis, so no full-year numbers there, all broken down into half-year increments. So that means we have 10-year periods in there, looking or focusing on revenue, operating cash flow, and margins, more than likely gross margins, but also look at operating margins as well. Also focus on any interesting points I found in the company's results, looking at their presentation, looking at their financial statements, that sort of thing. And one of the reasons I'm actually doing this video is for selfish reasons. It's giving me the impetus to actually look at some of these results in a finer detail. And that's exactly what I've done with these three companies today. And then finally, we'll be looking at the chart. There are some investors out there who don't look at charts whatsoever, and I think that is a mistake. Chart will tell you a lot about how sentiment is driving the share price higher, lower, or going sideways. So I think it's a good idea. And the other thing is, sentiment is the main driving force behind the share price movement in the short to medium term. So you really have to take into account where sentiment is right now in any company you are looking at investing in. First company we'll be looking at is Kelly Partners. This is a chartered accountant company. Now, to be fair with you, I don't really like these sort of companies where the main assets of the business are people, so accountants, lawyers, those sort of business. And quite a few years ago, we did see those lawyer type companies like Shine and Slater and Gordon go through some tough periods. So these are sort of companies I don't like to invest in. However, in saying that, Kelly Partners have done a pretty good job over the past few years. Now, this is their financial data going back 5 years, looking at half-year increments, focusing on revenue, which is in the blue, cash flow from operations, which is in the peach, and then the gross margins is that green line. And the main things I'm looking for here are increases, consistent increases in revenue and cash flow from operations. Now, some experts, professionals will tell you this is no point looking at this because this is all in the past and the market is pricing company based off the future. But if we see revenues and cash flows from operations consistently climbing through time, that should give us more confidence that the company will be able to continue doing that in the future. It doesn't guarantee it, but it'll give us more confidence. And that's exactly what Kelly Partners has done. Over the past 5 years or 10 half years, revenue have climbed consistently through that time, increasing from $9 million to $31 million. And just as importantly, cash flow from operations have increased through time as well. And in the most recent half year, had a record revenue, $31 million, increasing from $24 million the previous half year or $25 million the previous corresponding period, and cash flows from operations up to $11 million. The reason I like to look at the history, particularly for cash flow from operations, is you sort of weed out any changes in working capital, and that can have a pretty big effect on one period. And that's why I do like to look at history of cash flows from operations. The other thing to mention here is gross margins, sticking around between about 50 and 58%. Right now it's at 53%. I would prefer to see gross margins maybe slowly climbing through time. Definitely don't want to see it falling through time, but probably safe to say with Kelly Partners, gross margins have been going sideways over the past 5 years. Now onto their guidance, and they do have guidance for not only the rest of financial year 22, but also financial year 23 and 24. The most interesting thing here, and another reason why I don't or am not the biggest fan of Kelly Partners, is simply because they have the roll-up model, so they make quite a few acquisitions, and that is fraught with danger. We have seen companies fall flat on their feet. GA Education comes to mind, Slater and Gordon comes to mind, but a lot of times these roll-up models, these companies who are fairly acquisitive, eventually do find some problems. And they will continue down their path based off this guidance they have over the next 3 years. They expect to double revenue by financial year 24. However, majority of that is through acquisitions. There's a little bit of organic growth there, but the majority of their growth in revenue over the next few years will be through acquisition. So I'm not really sure I like that business model for the company. But they do expect or hope to grow revenue from $46.4 million in financial year 20 to $81.3 million in financial year 24. Now onto the chart for Kelly Partners, and before we have a look at the chart, the market cap of this company is $225 million. That's at a share price of $5. And this chart goes back to July 2020, and the share price has gone one way since then. That is up. This is the sort of chart you want to see for a company in your portfolio, going from the bottom left to the top right. In fact, the share price has increased from less than $1 all the way to a high, not a high, but current share price of $5.01. When they did release the half-yearly results on 7th of February, the market did like it. Share price rose 10% on that day and has sort of gone sideways since then. Did reach a high of about $5.45. So everything's looking really good for Kelly Partners right now. Share price in a well-defined uptrend and a lot of positive sentiment around this company, and the fact that they look like they will continue to grow over the short to medium term, next 2 or 3 years, does give us confidence that this trend could continue for a while from here. Now onto the company that sort of was mixed. Initially, it looked really good. The market reaction was quite stellar, but the share price has pulled back. I'm getting a little bit ahead of myself right now because we'll talk about that when we look at the chart. Anyway, JB Hi-Fi is a company I have owned in the past. In fact, so I bought JB Hi-Fi way back in 2012 or 13 when the share price was like $8 or $9. I thought I was a genius when I sold the company for double my money, my original investment. But the share price has kept on increasing. And as we look at their 5-year financial history here, just like Kelly Partners, revenue has climbed through time. Now, JB Hi-Fi did make an acquisition of the Good Guys, and that has helped the company grow their revenue, but revenue has definitely grown. In fact, it's grown from 1.8 billion to 4.9 billion. The other really interesting thing here that I did find interesting anyway is the cash flow from operations. If you go back a few years ago to 2016, 2018, you'll notice there is a bit of seasonality when it comes to not only revenue but also cash flow from operations. So this company did perform financially better in the first half of the financial year, which makes sense because that includes Christmas period. You can see back in 2016, in fact, they were operational cash flow negative by 75 million in the second half of that year, and then operational cash flow positive by 276 million the following half year, and that happened over the next few years. But things have turned around recently, the last few years, where the company is now operational cash flow positive in at least, or the lower favourable season, the second half of the year. And the most recent half year wasn't quite as good in terms of revenue than the previous corresponding period last year. Revenue did fall from 4.9 million to 4.8 million, but you also notice operational cash flow zoomed up from 446 million to 850 million. That's the first thing that I did notice, and I wanted to understand why operational cash flow was so massively higher than it was the previous corresponding period. The other thing I've concluded here is gross margins, and gross margins stay around 21% to 22.4%, so fairly stable gross margins when it comes to JB Hi-Fi. Now to the question of why did operational cash flow for JB Hi-Fi increase significantly from the previous corresponding period? And when you look at the cash flow statement, there's no answers there, and it's the one fault of the cash flow statement, particularly when it comes to changes in working capital. I would like that sort of information there, but you can dig it a little bit deeper. And usually when I do see something that does intrigue me or interest me in the cash flow statement, in particular, a massive increase or decrease in operational cash flow from the previous corresponding period or even previous period, I will go straight to the balance sheet. And I'll look at changes in inventory, changes in trade receivables, and changes in trade payables. And if we go to the liabilities of JB Hi-Fi, we'll notice a massive increase in trade payables from the previous corresponding period. In fact, it increased from 650 million to 1.2 million. So that means there's all of these debts or things they have to pay for that they haven't quite paid for. And that's why there was a massive increase in operating cash flow. And they actually mentioned this also, if I remember correctly, in their presentation, a group cash flow statement, which is on the top here, and changes in working capital was mentioned. So they went from EBITDA started EBITDA and worked their way backward to figure out net cash flow from operations and then net cash flow from investing. So if you start off with EBITDA, 529 million, but changes in working capital was the most important thing there, 482 million. So when you see a positive in changes in working capital, that's sort of a decrease in working capital, not an increase, it's a decrease. You go back, they've also provided half year 2020, half year 2021, and changes in working capital in both those half years was actually positive, so minus 34.6 and negative 17.7. And this is the why operational cash flow was quite large for JB Hi-Fi in this most previous half year. You do have to take that into account. They even mention it on the right here. Operating cash flows and operating cash conversion are up significantly due to the reduction in net working capital. So again, when you see a positive in the change in working capital, that's a reduction in net working capital, not an addition. And that's why, again, we saw a massive increase in operating cash flow for this company. So now on to JB Hi-Fi's chart, which goes back to September 2020. Before I get there, the market cap of this company is 5.6 billion. That's a share price of 49 million. But the really interesting thing about JB Hi-Fi is what's been happening with the share price over the past 15 months. It's been going sideways. In fact, it's trading in this channel, which I portrayed by these two horizontal lines. The bottom of the channel is around $43. The top of the channel is right on, well, in between $54 and $54.50. When the share price gets to the top of the channel, share price pulls back. When the share price gets to the bottom of the channel, which has happened 4 times during this period, the share price has increased. And on the back of the release of their half-yearly report, the market really liked it. Share price increased 5% on the 14th of February, and then a further 4% on the 15th of February. And the share price reached the top of this trading range, and the share price has pulled back from $54.25 all the way down to $49. And if I see the share price fall towards $43, that could be a low-risk buy entry point for this company, particularly if you like the long-term potential of this company and think the share price will be significantly higher in 5 years' time. Now on to ADOREBEAUTY, the zero of these 3 companies. Now they haven't been on the ASX for too long, so we don't have 5 years of financial history. We have only 5, I was going to say semi-years, but half years of financial data here, going back to, that's the first half of financial year 20. Now, the first thing here is revenues have increased through time, even though it's only a sample size of 5, but they have more than doubled from 52 million to 113 million. The other thing is I've included gross margins and operating margins. Gross margins have increased slightly from 31% to 33%, but operating margins, which is very important here because this company is operating on very low margins, has decreased slightly from 2.6 to 2%. So the main thing I'm looking for here is operating margins, because this company is operating on very low margins and more than likely will continue to do that unless they have private labels, private products, and they can expand those private products, sell way more of those private products, because private products, if they are doing that sort of thing, would have significantly higher margins. And because this company is operating on fairly low margins, operating margins, they don't have much income or profit and much operating cash flow. In fact, their operating cash flow for the most recent half year was negative 2.6 million. They were profitable by $2 million, but at this point in time, we are not seeing much growth when it comes to profit or cash flows from this company right now. Now let's just discuss a few interesting things about ADOREBEAUTY's financial statements. In fact, I'm going to start on the right here because that is the cash flow statement. And I'll always go straight to the cash flow statement. And ADOREBEAUTY was operational cash flow negative in the most recent half year by 2.6 million. Receipts to customers, 125 million, but they paid 125.7 million to suppliers and employees. So not quite as good as the previous half year or previous corresponding period where they were operational cash flow negative, but only 162,000. But that doesn't tell you, or the cash flow statement doesn't tell you the whole story. You have to dig a little bit deeper. And one of the things I do want to focus on when I say whether a company is operational cash flow negative, positive, or anything like that, is changes in working capital, in particular inventories. And so on the bottom here, the bottom left, is their assets, so straight to the balance sheet. And inventories actually did increase from 14.9 million to 21.9 million. So if inventory stayed roughly the same from the previous year, this company would have been operational cash flow positive in the most recent half year. Now, they did mention in their commentary that those inventory levels have dropped off after the end of the end of the half year. That does make sense. So they wanted to build up inventory for Christmas, and those inventory levels have now fallen because Christmas has come to an end. Now, in their profit and loss statement, revenues have climbed or grown from 96 million to 113 million. So right here, you can see the difference between revenue and receipts. They're not identical. They're almost talking about the same thing, but they're not identical. The revenue significantly lower than receipts when you compare the two here. But the main thing I want to focus on here in the profit and loss is even though revenue did increase by 17 million, we also saw significant increases in their costs or expenses. Advertising and marketing grew from 11.9 million to 15.9 million. Employee benefits expense increased by 1.5 million, and other operating expenses increased by over 1.5 million as well. The other thing you have to take into account is in the previous half year, the previous corresponding period, they spent $5.2 million on initial public offering and transaction costs. That was a one-off, so they didn't have to pay that in this particular half year. So if you compare the two half years, I probably would say the previous corresponding period was a better half year for ADOREBEAUTY. Now, management probably say differently. They say, or probably would be saying, they are spending to grow in the future. And in fact, there was a bit of commentary here which stated Adore reaffirms its target to achieve an EBITDA margin of between 2 and 4% in the short to medium term. So again, a very low margin business, while reinvesting to drive above market growth. Again, they're talking about reinvesting, spending money to drive above market growth. And when they're talking about driving above market growth, they're talking about revenue. They're not talking about profits or cash flow. They are obsessed with growing revenue. In the longer term, as the business grows revenue, scale benefits are expected to increase operating leverage and deliver further EBITDA margin expansion. Who knows what in the longer term means? They could be talking about 5 or 10 years down the line. The market has punished ADOREBEAUTY over the past, ever since they listed on the ASX. But it will be coming, or has become, a little bit more interesting, particularly if they can grow their margins, see some operating leverage, become more profitable, operating cash flow. ADOREBEAUTY would be looking way more attractive right now than it did just a few months ago. Now, as we turn our attention to ADOREBEAUTY's chart, this goes back to when they listed on the ASX. This is the complete opposite sort of chart to what we saw with Kelly Partners. So Kelly Partners is the sort of company you want to be owning because the chart's going from the bottom left to the top right, while the share price in ADOREBEAUTY has gone from the bottom or the top left to the bottom right. That means the share price has been dropping ever since this company listed on the ASX. In fact, there was a lot of hype when this company did list. I still remember that. And the share price reached a high on the day they listed of $7.40. But the share price did drop on that day, and then the next day, in fact, the day after they listed, share price dropped from about $7 all the way down to $5.60. So a significant drop in share price, and that hype fell away fairly quickly. And the share price has just continued to drop and drop and drop. In fact, the fall in the share price has accelerated over the past few months, ever since the start of the calendar year 2020. Share price has dropped from $4.40 to a current share price of $2.12. So the market cap, the share price has halved in the last 2 months. And when they released the half-yearly report, share price dropped 8.2% and has continued to fall since then. So a lot of negative sentiment when it comes to ADOREBEAUTY. Well-defined downtrend. No reason right now to take a position in this company. You can remain patient. The market cap, though, 197 million at $2.12. I probably could understand why some value investors, some long-term investors, are seeing this as an attractive proposition right now, particularly if you think this company will succeed in the long term, and particularly when you compare it to the valuation of the company when they listed, which would have been probably around $600–700 million. So a significantly smaller company right now. But so much negative sentiment in this company, we don't know how far the share price could fall from here. That's all I have for this February 22 reporting season video, part 1, featuring ADOREBEAUTY, JB Hi-Fi, and Kelly Partners. If I had to pick one of these companies as an investment over the long term, say 5 years, probably lean more towards JB Hi-Fi at this point in time. And one of the reasons I probably would lean towards JB Hi-Fi is simply because there's always been this competitive risk when it comes to this company. In fact, 10 years ago, when I did put some money into the company, they were the most shorted company on the ASX because they thought Amazon was going to kill the business. But JB Hi-Fi have weathered that storm particularly well, and there's no reason to suggest they won't be able to weather that storm for the next 5 years. But there's always going to be that risk of competition in the future. But they just do a brilliant job at what they do really well. Now, Kelly Partners is a slightly different story. It's not the sort of company or business model I would invest in, where you're relying on labor or human capital, that sort of thing. So I'm talking about accountants, lawyers. But Kelly Partners have done a wonderful job over the past 5 years, even though they've really grown through acquisitions. There's a little bit of organic growth there, but they have probably the best looking chart when it comes to these three companies by far. ADOREBEAUTY, on the other hand, looks ugly. Their chart looks really ugly, and I think the market wants to see some scale, some operating leverage when it comes to this business, but management is totally focused on growing revenue. That's what they're most interested in. They don't care at this point in time on growing or even having any sort of operating leverage, any sort of profit, any sort of operational cash flow. If you want to leave any questions about these companies, just leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a great day. Bye.